Hello traders. I'm again here with another video called Essential Guide for Chart Patterns. Chart patterns are one of the most powerful tools you can use in your trading. Here is some example how the chart pattern will help you. Read market condition accurately so you know whether to buy or sell. Get out of losing trade quickly and better manage your risk. Find high probability trading opportunities. And that's why I am here today to show you how to trade on chart pattern like a professional trader do. So before begin, if you are new in the channel, I would really appreciate if you subscribe and follow the channel. And thanks a lot who already subscribed. Also please join me on Telegram channel where I published update regularly along with chart analyze. I need nothing from you except support. Your support can inspire me to make more video in the future. So let's begin to the point without wasting your time. Here how the chart pattern can help you. Chart patterns can predict the future accurately. When the chart pattern don't work, you must know every chart pattern if you want to trade it profitability. Many traders think that chart pattern can predict the future like magic. For example, you see a head and shoulder chart pattern and think the market is about to head lower. So, before you know it, you go short, but the market reverses higher and you got stop out. Here is an example. Here you can see a head and shoulder pattern. This is left shoulder and this is head, right shoulder. Here is neckline. So as soon as you see that head and shoulder formed and you decide to go with sellers, but immediately market reversed and made a new high. So the pattern didn't work here. Here is the things. Chart pattern can't accurately predict the future, but the chart pattern can help you assess market condition and manage your risk when the chart pattern don't work. Now, after a few failed attempts at trading chart pattern, you will claim it does not work. As an example, I show you head and shoulder didn't work. So, here is the secret. Whenever you trade the chart pattern, it must be within the context of the markets. Let me explain using couple of examples. Number 1. You spot a bull flag pattern in a downtrend. Number 2. You spot a bull flag pattern in an uptrend. Now, let me ask you, which chart pattern would you trade? 1 or 2? Next, you must know every chart pattern if you want to trade it profitability. There are possibly hundreds of chart patterns out there. You can try to memorize the shape and meaning of each patterns or learn how to read the price actions of the markets. So you can understand any chart pattern that comes your way without memorizing. Which do you prefer? Read the price actions? This is an important, so pay attention it. Trending move. You are probably wondering what is a trending move? A trending move is a longer leg of trend. If the candles are larger in an uptrend, it signals strength as the buyers are in control. If the candles are small, it signals weakness as the buyers are exhausted. Here is an example of trending moves. As you can see in this chart, that market is making new high every times. So this is called trending moves. Now let me talk about retracement moves. A retracement move is the shorter leg of the trend. If the candles are larger, it signals the counter trend pressure is increasing. If the candles are small, it's a healthy pullback and the trend is likely to resume itself. Here is an example of retracement move. As you can see, every time market making new low, and this is a retracement move. That market is retracing this trend line. As you can see, market is retracing this trend line. So this is called retracement moves. Okay, let me talk about swing points. Swing points refer to swing high and lows, obvious points on the chart where the price reverts from. Here is an example. So in this chart, as you can see, market is making new low every times, and this is a retracement moves. This is swing high and this is swing low, swing high. Again we can see new low, and this is called swing low. Again swing high. So as if you observe, every time market reversing even before touching this previous high. So this is called swing point. Swing high, swing low, swing high, again swing low, again swing high. This is an important because it will let you know whether the market is an uptrend, downtrend, or in a range. As a guidelines, if the swing high lows moves higher, the market is an uptrend. If the swing high lows moves lower, then the market is an downtrend. If the swing high lows are not moving higher or lower, then the market is in a ranging market. Now apply what you have learned already. You might be thinking what to do with reading chart pattern. Well, that's what I am here today. Now let's talk about reversal chart pattern. Let's have a look at an example, head and shoulder pattern. In this chart, as you can see that A and C shows the market is an uptrend as the price made new swing high. But if you look at the E, the price failed to make a new swing high. At the D, you can notice the sellers become stronger than the B. This doesn't look good for the buyers. But if the swing lows doesn't break, the uptrend is still intact. Now the price broken below than the swing low and the retracement move is getting stronger. Notice the range of the candles getting larger. Overall, the sellers are in control and the market is likely to move lower from here. Most of you know already about the pattern. This is called head and shoulder chart pattern. Let's have a look at an example for double top pattern. In this chart, if you observe the A strong trending move higher as the price made a new high. The B retracement moves lower which form as a swing low. The C, the market made another push higher but failed to break above the previous high. This is a sign of weakness, but the uptrend is still intact. The D, the market retraced the swing low. The E, market unable to test the previous high even. It means buyers get more weaker. The F, due to buyer become weaker, market broke the support levels. The G, retracement for breakout and now time to enter sellers confidently. This is also known pattern for all of us called double top pattern, and one form at lower called double bottom patterns. So now let's talk about some continuation pattern. Look at the chart and ask yourself, is this bullish or bearish chart pattern? Here A, C, D and E, the price made lower high into resistance. This is a sign of weakness as it tells you sellers are willing to sell at lower price. The B, this is an area of strong support, the last line of defense from buyers. Also, there are likely stop loss order below it from the trader who are long. Overall, sellers are in control. If the price broke the levels, the market will likely to move lower. The pattern also familiar with all of us called descending triangle. Now tell me, what about this chart pattern? Let's analyze together. A, strong trending moves lower. B, weak retracement move. Buyer have difficulty pushing the price higher. If the market broke the levels, sellers will make another moves here. This is also known pattern for all of us called bearish flag pattern. Now let's talk about how to trade on pattern chart like a professional traders. You have already learned how to understand the chart pattern and how to act with them. You are thinking time to look for head and shoulder, triangle or flag pattern to open a position. But wait, not so fast. Why? Because remember, not all the chart pattern are create equal. You may have some different chart pattern, but you need to choose the one where has higher probability of success. So the question is, how do you find them that will give you higher probability of success? Don't worry, I'm still here. Here are few tips to look for. Trend, area of value, build up. Let me explain. The most popular word is the trend is your friend. Yes, this is correct. And it's true that the trend is your friend. So, if you are trading the chart pattern, you would want to be trading in the direction of trend. For example, buying a bull flag in an uptrend. As you can see in the chart, the trend is an uptrend, and here we can see some bull flag patterns. So as soon as break out the pattern, you look for buy position. As soon as break this levels, you look for buy position. Again, as soon as break these levels, you look for buy position. Or selling bearish flag in a downtrend. Here you can see trend is a downtrend, and we can see bearish flag pattern. So as soon as broke these levels, we can look for sell trade. As soon as broke these levels, we can look for sell trade. Now let me talk about area of value, how to buy lows and sell highs. Let me ask you, when you go to the supermarket to buy apples, what is the price you are willingly to pay? Probably less than the seller's asking, right? But how much less? Like $5? But what if sellers ask for the price $5? Will you get it free? No. So you need to identify the best price for the apples. So trading like same. You need to find an area of value, and it's very simple. You can find area of value by using some tools, indicators like support and resistance, moving average, trend line, and so on. Let me show you some example. If you observe the chart clearly, This is a 200 moving average. Market is an uptrend, and this is a trend line which is respecting by this market. So here we can see market broke the 200 moving average, and again we can see retracement moves, and it got support from moving average. Also the trend line, also you can see this is a previous resistance levels become support. So this is an area of value. So let me show you another example. This is also you can see uptrend market, and this is a trend line market is respecting. Also this is a moving average which has broken here, and this is a retrace levels. Also you can see bullish flag pattern. So this is an area of value to open a buy position. Now you know support is an area where potential buying pressure could comes in, and it is more probability if supported by couple of value together, like flag pattern supported by MA, also supported by trend line as I showed you. Now let's moving on the build up. Before moving, I would like to let you know that I made a complete course of educational video about candlestick psychology, which is 9 classes on our East class. So if you are interested, please let me know. You can find the details in the video description below. So when you trade breakouts of a chart pattern like double bottom, do not trade blindly on every breakout, especially when the price has made a big moves prior to the breakout. Why? Because buyers would look to take profit at resistance. Also sellers would step in to short the market, and this lead to a low probability breakout trade. Here is what I mean. In the chart you can see this was very strong resistance levels. It has been respected several times. Okay, trying to break out, and finally break the level, but it became a false breakout. You are probably wondering, so how should I trade breakout? Well, you look for a build up to form at the horizontal boundaries like support and resistance, because favorable risk reward, sign of strength, profit from losing traders. So what does it mean by favorable risk to reward? You have a logical place to set your stop loss, and this offer a more favorable risk to reward. When the price forms a build up at resistance, it's a sign of strength, because it tells you the buyers are willingly to buy at the higher price even in front of resistance. Profit from losing traders. Imagine if the price is at resistance, what would most traders do? They will go short and have their stop loss above resistance. And the longer the price hover at resistance, the more traders will short and buy stop order would cluster above resistance. But what happens if the price break above resistance? This cluster of buy stop order gets triggered, which fuel more buying pressure, and this will help to make real breakout. Here what I mean. Now you have learned how to trade chart pattern and identify high probability trading setup. Next, you will discover how you can use it to manage your risk. Here is the things. You can use the structure of the chart pattern to set your stop loss. This means you set your stop loss at the levels where if the price reaches it, it would destroy the chart pattern. Let me share with you a few examples. You know, the inverted head and shoulder is a bullish reversal chart pattern and trader might go long on the break of the neckline. So, where a logical place to put your stop loss? Well, you can set your stop loss lower the lows of the right shoulder because if the price break the level, it would invalidate the inverted head and shoulder chart pattern and you want to get out of the trade. Here's what I mean. Does it make sense? Example 2. The bearish flag is a bearish continuation chart pattern and traders might go short on the break of the lows. And where would you set your stop loss? Remember, you need to place it at the level where if the price reaches it, it would destroy the chart pattern. So, one way is to set your stop loss above the high of the bearish flag pattern. Here's what I mean. Now you might be wondering, which are the most profitable chart patterns? Well, the truth is, it doesn't exist because there are no such things as the most profitable chart pattern. Why? Because market condition beat any chart pattern at any times. For example, if the market is in a downtrend, then any bullish chart pattern will not work well because the trend is down. And if the market is an uptrend, then any bearish chart pattern will not work well because the trend is up. So the bottom line is forget trying to find the most profitable trading patterns. It doesn't exist. Instead, identify the current market condition and then trade the appropriate chart pattern. You will do much better this way. So, what next? Please let me know in the comments box below and please make a thumbs up if you enjoy the video. Thanks a lot for watching. See you soon.